The U.S. mortgage industry is seeing its first lenders now going bankrupt following an abrupt jump in borrowing rates. The wave of bankruptcies to come may be the worst seen since the burst of the housing bubble some 15 years ago now. Fortunately for us, this time around, there is no systemic collapse coming because there hasn't been as much borrowing overhang and because the big banks pulled back on mortgages in the wake of the financial crisis. But more firms are now controlled by standalone lenders. As mortgage volumes have fallen sharply this year, many are struggling to stay afloat. According to Nancy Wallace, she's the chairman of real estate groups at the University of California, the nonprofits are not well capitalized, so when the mortgage market tanks, they're in trouble. Back in 2004, only about 1/3 of the top 20 lenders in the refinancing business were independent firms. Last year, 2/3 of the top 20 were not bank lenders. Since 2016, banks have seen their market share drop to around 1/3, down from about half according to Inside Mortgage Finance, a news and data provider. Many so-called shadow lenders are set to come out relatively unscathed by the slowdown, but a few lenders have already stopped operations or dramatically reduced their operations, including End Sprout Mortgage and First Guarantee Mortgage Corporation, which I believe was really big in the first lien HELOC space. Both specialized in riskier loans, not subject to the government's guarantee. First Guarantee, the firm majority owned by the fixed income behemoth Pacific Investment Management, filed for bankruptcy, saying it failed after making loans earlier this year that fell in value. Once interest rates started rising, lending volumes dropped throughout the sector. According to court documents, that means that companies could no longer find enough new loans to pool together or secure enough funding to continue operations. First Guarantee employed 600 people before filing for bankruptcy in June and then made $10.6 billion in loans last year. Days before seeking court protection, the company laid off 471 of its workers because it wasn't getting enough funding to get through the cash crisis. So how did independent lenders, which run the risk of being over leveraged, gain so much of the market share? This happened because banks pulled so heavily from the sector in the wake of the financial crisis in 08, which began because of too much mortgage-related borrowing. Regulators have frequently encouraged that pullback, and it is still happening. For example, Wells Fargo, Wall Street's largest company in U.S. mortgages, is planning to scale back its mortgage empire, according to a report from Bloomberg. Unlike banks, standalone lenders typically have no contingency programs that they can turn to for funding when times are tight, nor are they guaranteed deposits. They depend on loan lines, which are typically short-term and dependent on the mortgage prices. So they are subject to margin calls when stuck on a bad asset, and this can lead to bankruptcy. Many independent lenders manage their risks very well, and the picture is not quite as scary for lenders that do work heavily with government-backed companies such as Fannie Mae and Freddie Mac. They often can access emergency financing from government-sponsored enterprises should they face difficulty. But those lenders who are making riskier loans and who do not often partner with government-backed companies have few options when facing a margin call. A big reason these companies are struggling is because loans cannot go to the GSEs or government-sponsored enterprises to get funded. Tight financing options are made more painful by the tightening fiscal conditions, and many more lenders are seeing their lending values fall. The recent rise in interest rates is beating out home loan values made only a few months ago, which means a mortgage made in January that was not subject to government's guarantee might have traded somewhere around 85 cents on the dollar as of early August. Lenders typically look to write loans for around 102 cents to cover their front-end costs. For a lender who makes loans down to 85 cents, losses can be devastating even when not realized. Now, on top of this, overall mortgage applications are down by more than 50% so far this year, according to the Mortgage Bankers Association. These economic conditions are prompting banks, which offer lines of credit known as depository banking, to issue margin calls and reduce their lending. And banks have emergency funds that they can draw on during times of crisis, and that often allows them to keep themselves afloat during difficult times, but it's not universally true. as emergency financing from the Fed is generally available only for solvent institutions that stand a chance of recovery. In the most recent economic downturn, so many banks had so many bad loans and struggling assets of every type that hundreds failed. Fortunately, the numbers of lenders going under right now remain low. So don't expect to see a crisis like the one in 2008. Lessons were certainly learned from that experience, and the market is set up to avoid a similar catastrophe in the future. There are a lot of moving parts to the housing market. Focusing on any single part may give you an indication that things are looking bad, while other spots may give the exact opposite indication. It's important to keep our eyes on all aspects, trying to judge them together. And yes, it's quite messy right now and certainly volatile, and it's complicated to do this, but the end result gives us a lot more to work with as we focus on making the most out of any situation the housing market finds itself in. Cash flow is the goal, folks, always. So keep your eyes and ears open in the coming months as the housing market continues to evolve. I, for one, am doing everything I can right now to make sure I have the capital available to leap on the opportunities that present themselves. This means keeping my expenses low while simultaneously increasing my cash flow through various streams of income, along with accessing more and more capital, these debt weapons. Now, for anyone that's new to the channel, we do talk about strategies for cutting unnecessary costs while also building cash flow producing empires. Make sure you subscribe if you haven't already so you can catch every video. Thank you so much for joining today. Make it a great day, and keep on cash flowing. See you soon.